So if you ever look at a driver's ed manual for your average teenager, it is, incredibly straightforward.
Right, yeah. Stop at red lights, that sort of thing.
Exactly. Keep your hands at 10 and 2. Check your blind spots. It's basically a document designed for a Tuesday afternoon trip to the grocery store.
Yeah, very low stakes.
But imagine, just for a second, a driver's ed manual written specifically for a Formula One race.
Oh, well, the paradigm shifts completely at that point. You aren't talking about parallel parking anymore.
No, not at all.
You're talking about managing a machine that is essentially, a missile with wheels.
Right.
And you're surrounded by other drivers who are pushing the absolute limits of physics. The stakes are astronomical, and the margins for error are just microscopic.
Everyone is driving incredibly fast. The pressure is unimaginable. And, the prize money is in the billions.
Yeah.
And this manual, these highly specific, rigid guardrails, it's the only thing keeping them from crashing spectacularly into the crowd.
That's a great way to frame it.
Thanks. Because today, we are doing a deep dive into the actual rule book that governs these high-stakes drivers on Wall Street. We're looking at the CSA Institute's Code and Standards. And I know a set of professional standards might sound like dry reading.
It does sound a bit like a compliance seminar.
Right. But it is actually this profound, almost obsessive catalog of human temptation.
It really is. It reads like an exhaustive map of our psychological vulnerabilities.
Yeah.
And for anyone listening, whether you have a 401k or whether you use a financial advisor, or even if you just want to wrap your head around the invisible forces dictating the global economy.
Which impact all of us.
Exactly.
Yeah.
These guidelines pull back the curtain. They reveal the hidden conflicts of interest, the subtle leverage applied to your money, and the incredible lengths the financial industry has to go to just to police its own people.
So let's start with what is arguably the most famous temptation in finance, right? The information edge.
Oh, classic.
We've all seen the movies. Someone gets a secret tip, they make a massive trade, and instantly they are incredibly rich.
Right, the Hollywood version.
Yeah. But the reality, of course, is far more nuanced, especially when we look at the rules surrounding material non-public information.
Standard 2A.
Yes. So let's look at a scenario from the sources involving two friends, Rodriguez and Hart.
This is a really classic example of how casual environments breed absolute compliance disasters.
Right. So picture this beautiful, exclusive golf course. You have Rodriguez, who is the chief financial officer of a massive company called Mega Retail.
Okay.
He's playing around with his longtime personal friend, Hart, who works as a local investment advisor. They're walking the fairway, just chatting, and Rodriguez casually mentions that Mega Retail is having an exceptional sales quarter.
Just bragging a little bit to a friend.
Exactly. He tells Hart they expect results to be almost 10% above current market estimates.
A seemingly harmless boast. I mean, the CFO is just proud of his work, right?
Right. But the very next day, Hart, the investment advisor, initiates the purchase of a large stake in a local exchange-traded retail fund, an ETF, for her own personal account.
Yeah.
Now, the rules dictate this is a clear violation of insider trading protocols. But I want to unpack the mechanics of this because it feels like a bit of a gray area.
How so?
Well, Hart didn't buy Mega Retail stock. She didn't trade the specific company her friend told her about. She bought a general retail ETF, which is, a basket of dozens, maybe hundreds of different retail stocks.
Right.
How does that qualify as an illegal trade? I mean, she didn't touch his company.
It's a brilliant question because it really targets the underlying architecture of the market. To understand why Hart's trade is illegal, we have to look at the concept of correlation.
Okay, correlation.
Yeah, Mega Retail is not operating in a vacuum. If they are a massive player in the sector, a 10% beat in their earnings is not just going to move their own stock price.
Right, it ripples out.
Exactly. It signals robust macroeconomic consumer strength. It tells the market that, hey, foot traffic is up, supply chains are clearing, and retail spending generally is just really healthy.
So a rising tide lifts all boats. If Mega Retail is doing that well, the whole sector is likely going to experience a bump when that news goes public.
Precisely. And Hart understood that. She attempted to monetize the insider tip while simultaneously trying to mask her tracks by using a broader financial instrument.
Oh, so she thought she was being sneaky.
She definitely did. She used material, non-public information to gain an unfair advantage in the broader sector. And the regulators are acutely aware of this tactic.
They've seen it before.
Oh, many times. Insider trading is not just buying the exact ticker symbol you were whispered about, right? It's acting on asymmetric information to generate literally any market advantage.
Wow. So she thought she found a clever loophole, but the guardrails are actually designed to anticipate exactly that kind of lateral thinking.
They have to be.
But what if the intelligence gathering is completely legitimate? What if you aren't handed a secret on a golf course, but you figure it out yourself?
Ah, the mosaic theory.
Yes.
Yeah.
There's this concept in the sources called the mosaic theory, and it honestly sounds like the defense for just being way too good at your job.
It really is. The mosaic theory is the ultimate shield for the diligent financial sleuth.
Okay, explain that.
The core principle is that an analyst can legally combine material public information, so data everyone has access to,
Right.
with non-material, non-public information to reach a conclusion that is ultimately material.
Okay, that's a lot of terminology. Let's stress test this with some modern technology to make it concrete.
Sure, let's do it.
Suppose I program an AI to scrape commercial satellite imagery. I buy photos of thousands of retail parking lots across the country.
Okay, completely legal.
Right. I have the AI count the cars every day for a month, and I compare that data to historical earnings. Based on the empty parking lots, I conclude a major retailer is going to completely miss their earnings, and I short their stock.
Interesting.
Is that a legitimate mosaic, or is that an unfair technological advantage? Like, is that illegal?
That is the modern frontier of the mosaic theory right there, and it perfectly illustrates the concept. It is absolutely a legitimate legal mosaic.
Wait, really? It feels like cheating.
It's not. Let's break down the components. The satellite photos. That's public information. Anyone with enough capital can purchase them.
True.
Now, the number of cars in a single parking lot on a random Tuesday in Ohio, that is non-material, non-public information.
Why is it non-material?
Because if you tell an investor, hey, there were only 20 cars at the Cleveland store today, that single data point is not going to move the global stock price. It doesn't matter on its own. It is non-material.
Okay, I see. But when my AI aggregates 10,000 of those non-material data points,
You build the mosaic, you assemble the tiny pieces into a macro picture, and suddenly your conclusion that the company will suffer a massive revenue miss, that conclusion is highly material.
and that's okay because I built it myself.
Exactly. The crucial distinction is how you arrived at the conclusion. You reached it through aggressive, legitimate research and data synthesis. You didn't get it because the CFO breached his fiduciary duty and just handed you the answer key.
So it's the difference between doing exhaustive homework and simply stealing the test.
That's a perfect way to put it.
But what happens when someone basically forces the test answers into your hands?
Oh, this is where it gets stressful.
Yeah, let's look at the scenario of Andrews and Wright from the sources. Andrews is a private wealth manager, and he is interviewing Wright for a research analyst position.
Okay.
Wright currently works at an investment bank, and during the interview, he really tries to demonstrate how important he is. So to impress Andrews, Wright drops a massive piece of material non-public information.
A terrible idea.
He reveals the details of a highly confidential, unannounced merger that his current firm is advising on.
It's a catastrophic failure of discretion by the interviewee, and it instantly creates a massive compliance burden for the interviewer.
Right, because Andrews is now essentially a hostage to this information.
Exactly.
He didn't ask for it, he didn't seek it out, he didn't do satellite AI research, but it's in his head.
Yep.
Now, human intuition suggests a few ways out of this, right? Maybe Andrews just waits a week before trading any of the involved stocks, assuming the merger will go public soon anyway.
Absolutely not.
Or perhaps he immediately convenes a meeting with all the other investment managers in his firm to warn them not to trade those specific securities so no one accidentally violates the law.
Honestly, both of those intuitive reactions are fundamentally flawed under the regulatory framework.
Really?
Right.
Warning your team is flawed.
Yes. The required action is that Andrews must immediately place the securities mentioned in that merger on his firm's restricted trading list. He has to shut down all activity on those tickers firm-wide without explaining why.
Without explaining why. That's wild. Break down the mechanics of why that is the only acceptable path.
Well, first, you cannot simply wait a week because merger negotiations are notoriously volatile.
Right, they fall apart all the time.
Exactly. They can drag on for months. or they can collapse entirely. So the information remains non-public until it is officially disseminated by the corporations involved. You can't just guess a timeline.
Okay, that makes sense. But why can't he warn his team?
Because information is contagious.
Okay.
By telling his team Andrews wouldn't be protecting them, he would just be spreading the infection.
Oh, I see.
The more people who possess material non-public information, the exponentially higher the probability that someone will, intentionally or accidentally act on it.
Like they might slip up on a phone call.
Right. Perhaps a colleague adjusts a portfolio weighting or casually mentions it to a high net worth client. The restricted list solves this by freezing the asset at the systemic level.
How does that actually work in practice?
In modern electronic trading environments, compliance departments can literally lock a ticker symbol in the firm's order management system. If any trader tries to buy or sell it, the system just rejects the order. Beep. Denied. No one needs to know why it is restricted, only that it is completely off limits.
That is fascinating. So stealing information, or even just stumbling upon it, clearly breaks the market by creating an uneven playing field.
Absolutely.
But, what is arguably even more destructive is when executives don't bother stealing information at all. They just manufacture it out of thin air to trick the algorithms.
Yeah, we are moving from the realm of asymmetric information into the realm of pure market manipulation.
Standard 2B.
Yes. This is where the structural integrity of the exchange itself is actively attacked.
Let's take the case of Pietro from the source material. Pietro is the president of a regional institution called Local Bank.
Okay.
He has hired a market maker to help find a larger partner to acquire his bank. Now, Local Bank is publicly traded, but they haven't announced they're looking for a buyer.
Got it. Keep it quiet.
Right. And the potential buyers are dragging their feet. They suspect Local Bank's next quarterly earnings report will be poor, so they want to wait for the bad news to drop.
They're hoping they can acquire the bank at a steep discount.
Exactly. It's a classic corporate standoff.
The buyers are weaponizing patience to secure a better valuation.
Yes. But Pietro is impatient. He wants to force the deal through immediately at a premium. So instead of issuing a press release or, adjusting his earnings guidance, Pietro personally places a buy order for 2,000 shares of his own bank.
And that number is key.
Right. The critical detail here is that 2,000 shares represents 4 times the average weekly trading volume for this specific stock.
And that volume spike, that is the smoking gun?
I was trying to conceptualize this, and the closest analogy I could find is from the early days of online auctions.
Like eBay.
Yeah. It's like listing a valuable item on eBay, seeing that legitimate buyers are hesitating, and having your friends place aggressive bids on your item just to create the illusion of a bidding war. The legitimate buyers see the price rising, they panic, and they pay a premium.
That is precisely the mechanism at play. It's a modernized, targeted form of wash trading. And to truly grasp why Pietro's action is so heavily penalized, we have to look at how modern markets actually function today.
Okay, unpack that for us.
The vast majority of market surveillance and trading is not done by humans staring at ticker tape anymore.
Right, it's all computers.
It is done by quantitative screeners and momentum algorithms. These algorithms are constantly scanning the entire market for anomalies.
Like a massive volume spike.
Yes. They monitor volume-weighted average price, order book depth momentum indicators. Volume is essentially the lifeblood of market sentiment. It tells the market that real capital is moving.
Okay, so when Pietro places that order...
When Pietro places a buy order that is 400% higher than the normal weekly volume, he is setting off a massive algorithmic tripwire. The quantitative screeners detect this sudden, massive injection of liquidity, and they interpret it as smart money moving in. The algorithms assume that someone, somewhere, knows something incredibly positive about Local Bank.
So the algorithms start buying automatically, which pushes the price up further, which triggers more algorithms. It's like a synthetic feedback loop.
A completely artificial reality. And then the hesitant human buyers look at their screens, they see the stock price surging on massive volume, and they panic.
Just like the eBay auction.
Exactly. They abandon their strategy of waiting for the earnings report, and they rush to finalize the merger before the target becomes too expensive. Pietro successfully manipulated the corporate valuation, not by improving his bank, but by exploiting the market's reliance on volume metrics.
That is wild. Faking market demand creates a false reality for institutional algorithms.
It does.
But, there's a parallel distortion that happens every day, directed at retail investors, and it relies on the psychology of certainty.
Misrepresentation.
Yes, standard 1C. We see this in the scenario with an analyst named Scott.
Right.
Scott publishes a research report stating that he expects the price of walked-in industries to rise by $8 a share. His reasoning. He explicitly states that the company's dividend will increase by $1.50 per share.
He uses the word will.
Yes. The catch is that Scott is fully aware this dividend increase is entirely contingent on Congress passing specific pending legislation.
He is taking a probabilistic political event and presenting it as an absolute financial guarantee.
Which violates the core mandate to separate fact from opinion. But I want to push back on the regulators here a little bit.
Okay, let's hear it.
In the real world, clients demand confidence, right? If an advisor says, well, there's a 55% chance the dividend might increase, assuming macroeconomic stability and congressional cooperation, the client is just going to find another advisor.
They want a crystal ball.
Exactly. Clients want a crystal ball. Aren't analysts just speaking the language the market demands?
They are, and that is exactly why the regulation exists, to stop them.
Really?
Yes. The psychology of certainty is incredibly dangerous in finance because the market is inherently unpredictable. When you're dealing with a client's life savings, their retirement, their kids' college funds, the fear of loss is profound.
Sure, it's terrifying.
And unscrupulous advisors prey on that fear by offering guaranteed returns or stating future projections as concrete facts to soothe that anxiety.
So it's the linguistic difference between an educated forecast and a fraudulent promise.
Exactly. In a regulatory environment, the difference between the word will and the word may is monumental.
Just one word.
Just one word. If Scott had written, in my professional opinion, the dividend may increase if pending legislation is passed, which could drive the stock price up, he fulfills his analytical duty without creating a false sense of security.
He hedges.
He has to. The rules force financial professionals to constantly strip away the illusion of certainty, even when certainty is what the client desperately wants to buy.
That makes a lot of sense. So faking demand or promising guaranteed returns, those are aggressive, overt violations.
Very overt.
But there's a far more insidious threat to market integrity, and it doesn't start with a multi-million-dollar trade or a fraudulent prospectus.
No, it rarely does.
It usually starts with a free lunch, or, in the case of a speaker named Long from our sources, an exclusive weekend getaway.
Ah, yes. Slow, subtle erosion of objectivity.
Right, standard 1B, independence and objectivity. So, Long is invited to deliver a presentation at a major industry conference.
Okay.
The host firm makes a very generous overture. They offer to pay for all of his conference-related travel and hotel expenses.
Which is pretty standard.
It is, but they also offer an add-on. The day after the conference, they are hosting an exclusive retreat at a championship-caliber golf course, and they offer to cover all of Long's expenses for that weekend as well.
It is a phenomenal networking opportunity and obviously very luxurious perk.
But the ethical guidelines are rigid here. Long may accept the basic conference-related expenses, though even that is frowned upon if his own firm can cover it, but he absolutely cannot accept the exclusive golf retreat.
Correct.
Now, on the surface, this feels a bit, puritanical. Long is a seasoned professional. Is a free round of golf and a few cocktails really going to corrupt his complex financial modeling?
It's a fair question, but it's not about overt bribery. It is highly unlikely the host firm pulls Long aside on the 18th green and says, we will give you this free vacation if you upgrade our stock rating.
Right, it's not a cartoon.
Exactly. Corruption in modern finance is rarely that transactional. It is about the psychology of reciprocity.
Okay, unpack that.
Robert Cialdini's sociological research outlines this perfectly. When someone gives you a gift, human nature dictates an intense, often subconscious obligation to return the favor.
You feel embedded, even if you don't consciously realize it.
Precisely. Fast forward 6 months, Long is back at his desk building a valuation model for that host firm. The data is borderline, the revenue projections are slightly soft.
Okay.
But as he adjusts the discount rate in his model, the memory of that beautiful weekend, the hospitality, the camaraderie, it acts as a subtle thumb on the scale.
Just a slight bias.
Yeah. Maybe he tweaks the growth assumption up by just 0.5%. That tiny subconscious adjustment changes the output from a hold to a buy.
Wow. And the regulators know they can't police the subconscious, so they simply cut off the stimulus at the source.
Exactly. No golf, no lavish dinners. Protect the environment to protect the objectivity.
But maintaining that pristine objectivity isn't just about warding off external perks, right? Some of the most intense pressure comes from inside the analyst's own building.
Oh, absolutely. The structural conflict between the sell side and the buy side. It is the architectural fault line of Wall Street.
We see this play out in the source documents, when the head of a firm's brokerage unit is pressured to alter a stock recommendation.
A classic internal battle.
Right. And the goal isn't to help retail investors. The goal is to flatter a corporate client so the firm's investment banking division can win a lucrative advisory contract for an upcoming merger. So the brokerage head is told to, play ball and upgrade the stock.
And the regulatory response must be an absolute, unequivocal refusal.
Why is it so strict internally?
To understand this, you have to look at how these massive institutions generate revenue. The investment banking division, the deal makers, they make their money by taking companies public, issuing debt, and advising on mergers.
Okay.
Their client is the corporation. They want the corporation to look as attractive as possible to the broader market.
Right. They're essentially high-end salespeople for corporate equity.
Exactly. But the brokerage division, the research analysts, they have a completely different mandate. Their job is to tell the retail investor, the public, the unvarnished, objective truth about those exact same corporations.
So they are naturally at odds.
Completely. If the investment banking division can pressure the brokerage division to write glowing research reports just to win corporate favor, the retail investor is unknowingly buying toxic assets based on compromised advice.
Which is why the concept of the internal firewall was created. It sounds dramatic, but it's a literal necessity.
Historically, these were physical Chinese walls. The banking division and the research division were placed on entirely different floors. Their key cards wouldn't even work on each other's levels.
Really? That's intense.
It had to be. In the modern era, it is heavily enforced electronic segregation. Emails cannot cross the barrier. Shared servers are rigidly partitioned.
But what happens when the information crossing the barrier isn't an email, but just human chatter?
That is the tricky part.
Consider the scenario from the text with Willier, a research analyst. He's standing in the firm's break room pouring a coffee, and he overhears another analyst talking to a colleague.
Okay, innocent enough.
The other analyst is ruthlessly trashing a specific stock, laying out all the reasons it is a terrible investment. Willier listens, goes back to his desk, and changes his own published recommendation on that stock from a buy to a sell.
He fundamentally violated the standard of diligence and reasonable basis.
Wait, really? If you work at a firm full of brilliant, highly paid analysts, isn't crowdsourcing your colleagues just good business? Why is it an ethical violation to listen to a smart coworker in the break room?
Because you cannot outsource your professional judgment to water cooler gossip.
Even if it's accurate gossip.
Even then, when a client reads a report bearing Willier's name, they are paying for Willier's independent, rigorous analysis. They are trusting that he pulled the SEC filings, he ran the cash flow models, and he stress-tested the assumptions.
And Willier didn't do any of that.
He did none of that. He heard hearsay and adopted it as his professional stance. If overhearing that conversation spurred him to return to his desk, conduct his own exhaustive research, and then arrive at a negative conclusion, that would be acceptable.
But you cannot bypass the work.
You cannot bypass the work.
That requirement for independent verification becomes incredibly complicated in the era of remote work.
Oh, it's a nightmare now.
Think about corporate Slack channels or overheard Zoom calls in a shared workspace. The modern office environment is designed to be frictionless, but compliance requires friction. The containment of influence is harder than ever.
It is a compliance officer's absolute worst nightmare, which is why the penalties for failing to disclose conflicts of interest are so severe.
Right.
Look at the scenario of Jameson. If she is assigned to research a company and she discovers that 2 directors of that target company also serve as senior officers at her own firm, the firewall is fundamentally compromised.
It's too close for comfort.
Exactly. The cleanest solution is to reassign the report. If she must write it, that tangled web of corporate relationships has to be explicitly disclosed in the very first paragraph, so the client can weigh the potential bias themselves.
Navigating internal firewalls and avoiding subtle biases is a huge intellectual challenge. But, it gets infinitely more complicated when we transition to the literal mechanics of how money moves.
Oh, yes.
Figuring out whose money is actually paying for what on Wall Street is a masterclass in misdirection.
We are entering the realm of fiduciary duty and the hidden currency of institutional finance. Soft dollars.
Soft dollars. It sounds so harmless, right? Like a loyalty points program.
It really does.
But understanding soft dollars is essential to understanding the structural plumbing of the market. Let's trace the flow of capital here. When an investment manager wants to buy 100,000 shares of a stock for their clients, they don't go to the exchange themselves.
No, they use a broker.
Right. They use a brokerage firm to execute the massive trade. The clients pay a trading fee, a commission, to that broker.
That is the hard cost of doing business. The client's capital is depleted slightly to pay for the execution.
But the transaction doesn't end there, does it?
Oh, it does not.
Brokerage firms operate in an intensely competitive environment. So, to incentivize the investment manager to route more client trades through their specific desks, the broker offers a rebate.
A kickback, essentially.
They say, if you generate enough commission fees for us, we will return some of that value to you, not in cash, but in soft dollars.
It is essentially a shadow budget granted to the investment manager, funded entirely by the trading fees paid by the client.
And what can the manager buy with this shadow budget? The regulations dictate that soft dollars must be used exclusively to purchase research.
Yes.
This means high-end data terminals, specialized macroeconomic forecasting, or bespoke industry reports. I was trying to conceptualize how strange this relationship is, and it reminds me of hiring a general contractor for a home renovation.
Okay, let's hear the analogy.
You give the contractor a budget to buy lumber and concrete. The contractor takes your money to the local lumberyard. Because the contractor spends so much of your money there, the lumberyard rewards the contractor with a brand new set of expensive power tools. Or maybe they paid for the contractor's advanced certification classes.
That analogy perfectly isolates the conflict of interest. The client is funding the operation, but the agent is reaping the institutional reward.
Exactly. It's wild.
And historically, before regulatory crackdowns, managers used soft dollars to pay for absurd expenses. Travel, lavish dinners, even their office rent.
Because money is fungible. If the broker buys my expensive data terminal using soft dollars generated by my client's trading fees, that is thousands of dollars I don't have to spend out of my firm's operating budget. It is a hidden subsidy.
Which is why the modern guardrails are so fiercely enforced. The rules explicitly state that soft dollars can only be used for research that directly assists in the investment decision-making process for the client.
So no office rent.
No office rent. If a manager tries to use soft dollars to pay for an employee's CFA exam registration fees or to buy new ergonomic chairs for the trading floor, it is a severe violation.
That makes sense.
But the real danger that regulators constantly monitor is churning.
Churning.
Yes. An unscrupulous manager might execute unnecessary trades in a client's account just to generate enough commission volume to pay for a piece of software they want.
Wow. So they are bleeding the client with 1,000 tiny cuts to subsidize their own overhead.
Exactly.
It all comes down to loyalty, doesn't it? Who are you actually serving?
Always. Fiduciary duty is paramount.
We see this tension clearly in the realm of proxy voting, particularly with a manager named Farnsworth from the text.
Proxy voting. This is where fiduciary duty collides with corporate politics.
Right. So Farnsworth manages a massive profit-sharing plan for the employees of the Jones Corporation. A shareholder vote is approaching regarding a major corporate restructuring.
Okay.
The president of the Jones Corporation calls Farnsworth directly and heavily implies that he expects Farnsworth to vote the plan's shares in favor of management's proposal.
A lot of pressure.
Huge pressure. Farnsworth hangs up, conducts his own exhaustive independent analysis of the proposal, and ultimately concludes that management's plan actually is the most beneficial path.
Okay.
So he votes the shares exactly as the president requested.
He voted in alignment with management, but he avoided an ethical violation. And the distinction lies entirely in his methodology and his understanding of who the client actually is.
Right, because the president hired him, the company pays his firm's fees, but the president is not his client.
Exactly. The clients are the participants and beneficiaries of the profit-sharing plan.
The actual employees.
They're factory workers, the administrative staff, the mid-level managers relying on that capital for their retirement. Fiduciary duty means Farnsworth's loyalty belongs exclusively to them.
So if he had just agreed on the phone call without checking.
If Farnsworth had simply rubber-stamped the president's request without investigating, or worse, if his research showed the proposal would harm the retirement fund, but he voted for it anyway just to secure his firm's contract with the company, he would have breached his core fiduciary mandate.
That is a very fine line to walk.
Very fine.
And, understanding who you serve is one challenge, but executing on their behalf fairly is a complete logistical nightmare.
Fair dealing. Standard 3B.
Right. Consider a broker named Smith. His firm decides to downgrade a stock recommendation from buy to a sell. Smith disseminates this new research to his client list. Minutes later, his phone rings.
Timing is everything.
It is a client who wants to place a massive buy order for that exact stock.
So the information is in transit, but the client is acting on outdated momentum.
Right. Human nature says the client wants to buy, execute the trade. But the standard of fair dealing requires Smith to stop the execution.
He has to pause it.
He must take affirmative steps to ensure the client has received the updated downgrade and explicitly advise them of the firm's new negative stance before processing the order.
Think about the friction that introduces into the system.
It's huge.
The client says, buy 10,000 shares. And the broker has to interject, wait, have you checked your email in the last 10 minutes? Because our quantitative models just indicated this company is fundamentally overvalued.
It's crazy. How does this even work in the modern era? We aren't mailing out monthly newsletters anymore.
No, we certainly aren't.
I am thinking about high-frequency algorithmic trading. I am thinking about institutional clients with direct fiber optic pipelines into an exchange, competing against retail investors who are getting push notifications on a smartphone app.
Right. The speed difference is astronomical.
So how do you ensure fair dissemination when millions of trades happen in milliseconds?
It is the great operational tightrope of modern finance. The standard dictates that a firm cannot disadvantage any client based on the size of their portfolio or their class of assets.
So everyone gets it at once.
You cannot prioritize your institutional hedge fund clients by giving them a 5-minute head start on a downgrade before notifying your retail accounts.
Even though the hedge fund pays you way more.
Even though they pay you millions more. To comply, major firms have to build incredibly sophisticated, simultaneous broadcasting systems. Every client, regardless of size, must receive the actionable intelligence at the exact same millisecond.
Executing trades with that level of rigorous fairness is incredibly difficult. But, how you report the results of those trades, how you package your success to the world is an entirely different landscape.
It is.
It is the landscape defined by smoke, mirrors, and the desperate need to appear flawless.
We are transitioning from the mechanics of trading to the marketing of performance. Standard 3D. This is where the temptation to rewrite history becomes nearly overwhelming.
Take the scenario of Cup, a portfolio manager. His firm wins a massive new institutional account.
Great news for him.
Yeah. Now, the firm has a deeply embedded, legally reviewed policy. New portfolios are only incorporated into the firm's overall performance composite calculation after their first full month under management.
It is a conservative, standard accounting practice.
Right. It prevents short-term volatility from distorting the firm's long-term track record.
Exactly.
But 2 weeks into managing this new account, lightning strikes. One of the major holdings Cup inherited in this portfolio is unexpectedly acquired by a massive conglomerate. The stock price doubles overnight.
A spectacular, unearned windfall.
Exactly. It's pure luck. Cup looks at this massive gain and makes a decision. He alters the firm's accounting policy exclusively for this specific account.
Just for this one.
Yeah. He decides to include it in the performance composite immediately, retroactive to the data transfer, ensuring that his firm's monthly marketing brochure will show off the chart's returns.
He essentially shifted the goalposts mid-game to capture a victory he didn't orchestrate.
But the actual financial gain is completely real, right? The money exists, the client got richer, but the source material flags this as a severe violation.
It is the ultimate manifestation of cherry picking.
Why is it so bad if the money is real?
To understand why this is penalized so heavily, you have to understand the lifeblood of asset management, raising capital. The only metric prospective clients truly care about is past performance.
Right. Everyone chases the winners.
There is an immense crushing pressure on portfolio managers to curate their historical data to look as attractive as possible. Cup didn't fake a trade, but he manufactured an illusion of systematic success. The windfall was dumb luck, but by retroactively changing the inclusion policy, he is presenting that luck to future investors as repeatable strategic genius.
The rules demand consistency. You cannot adopt conservative accounting when the market is flat and suddenly switch to aggressive inclusion rules the moment you stumble into a gold mine.
Exactly. The Global Investment Performance Standards, GIPS, they exist specifically to prevent this kind of historical revisionism.
And that desire to claim unearned glory extends down to the individual level as well. Consider an analyst named Paper.
Oh, this one happens all the time.
He is one of 5 managers co-running a highly successful equity fund. The firm downsizes, and Paper is let go.
Unfortunate.
As he applies for new jobs, He secures written permission from his former employer to use the fund's performance history in his interviews. But when he drafts his cover letters, he presents the fund's spectacular returns entirely as his own personal achievement.
Ah.
He conveniently omits the fact that he was only one-fifth of the decision-making apparatus.
It is the classic group project dilemma, scaled up to institutional finance. You cannot take sole credit for a collaborative victory.
Right. But let's look at a scenario that deals with ownership in a much more personal way. The story of Canon.
This scenario perfectly illustrates the massive cultural divide between the modern workforce and Wall Street's institutional doctrine.
Canon is an incredibly diligent employee. On the weekends, on her own time, she works from home using her own personal laptop.
Okay.
Over several years, she saves copies of correspondence, complex financial models, and research reports she developed onto her home hard drive. Then, a market downturn hits, and she is laid off.
A sudden separation.
She is back on the job market. She opens her personal laptop, takes the files she created during her weekends, and uses them to reach out to former clients for recommendation letters. She also brings copies of her financial models to interviews to showcase her analytical prowess to potential new employers. According to the regulatory framework, Canon has committed a severe ethical breach.
She has.
And I have to admit, this feels incredibly draconian to me.
I know it does.
She built those models. She spent her weekends working on them. It is her intellectual labor, stored on her physical property. How can it be a violation for her to use her own work as a portfolio piece?
It feels instinctively harsh, especially in today's gig economy mindset, where your professional output is viewed as an extension of your personal brand.
Right, like a graphic designer taking their portfolio with them.
Exactly. But Wall Street operates on an uncompromising, centuries-old doctrine of intellectual property and work for hire. The reality is absolute. Every keystroke Canon made, every model she built, belongs entirely to the firm that paid her salary.
Even the work done on a Sunday night on a personal MacBook.
Completely irrelevant. The firm compensated her to generate intellectual property for their benefit. When her employment ended, she was legally obligated to request explicit permission to retain those files.
And if they say no?
Without that permission, she was required to permanently delete them. By keeping the files, she violated strict record retention protocols. By using them to solicit clients or demonstrating them to rival firms, she breached severe confidentiality mandates. The firm owns the output. The individual is merely the conduit.
It is a stark reminder of the realities of the industry. You are a highly compensated gear in a massive machine, but the energy you generate belongs to the machine.
That's a great way to put it.
And this rigid insistence on ownership doesn't just apply to financial models and client lists. It extends to the very letters professionals put after their names and how they navigate their careers outside the office.
Standard 7, we are talking about brand protection at its most aggressive.
The rules surrounding the CFA designation itself are fascinatingly strict. You have people like Albert, who passes the second of 3 exams and decides to print CFA Level 2 on his business cards.
That is an immediate violation.
Or you have Quinn, who finishes his final exam on a Saturday, feels incredibly confident, and updates his resume on Monday to state, eligible for the CFA charter upon completion of required work experience.
Which is an anticipatory statement. He doesn't officially know he passed.
Exactly. It is a violation.
Why is the Institute so incredibly relentless about policing how its acronym is used? Like, who cares if you say Level 2?
Because the credential's entire value is derived from its difficulty and its exclusivity.
Right.
The CFA charter is universally recognized as one of the most grueling, demanding designations in global finance. The failure rates are notoriously high.
Yeah, it's brutal.
If the Institute allows candidates to claim partial mastery, if they allow CFA Level 2 to become a recognized status, they instantly dilute the brand. It creates the illusion of halfway competence.
I see.
If practitioners can creatively twist the terminology to imply they are charter holders when they are not, the credibility of the entire ecosystem collapses.
They protect the letters with the same ferocity that Apple protects its logo.
And that loyalty mandate extends to how you exit a firm. If you decide to leave your employer to start your own practice, the rules explicitly forbid you from soliciting your current clients before you officially resign.
Standard 4, loyalty to employer.
Your Rolodex belongs to the firm until you are out the door. If you want to moonlight and build a side business that might eventually compete with your boss, you need explicit written consent.
You are bound to the firm's interests until the very moment of separation.
But the absolute best scenario, the one that really humanizes this entire grueling regulatory framework, is the story of a candidate named Park.
Oh, Park, it is a moment of profound, relatable vulnerability.
Park is studying for the Level 2 exam. The pressure is immense. She buys expensive supplemental study material from a third-party prep company.
Very common.
She sits for the exam, and it is a bloodbath. She is exhausted, frustrated, and she feels like the prep company completely failed her.
We've all been there with tests.
Right. She goes home, logs onto a popular internet finance forum, and starts venting. She types out a furious review. "I am incredibly dissatisfied. The exam was brutally difficult. How could your prep service provide such limited instructional resources on the analysis of inventories and taxes when the actual exam had multiple, highly specific questions about them?"
It is the ultimate angry internet review. We have all written one in our heads.
But by clicking submit, Park committed a major ethical violation of the very rules she was just tested on.
She violated the standard regarding conduct as members and candidates.
Because she revealed the architecture of the exam itself.
Precisely. By explicitly stating that the secure test heavily featured inventories and taxes, she compromised the integrity of the exam for future candidates.
Oh, wow.
She gave away the weighting of the topics. The institute encourages feedback. Park was entirely within her rights to post, "The exam was incredibly difficult and I feel the prep material was inadequate."
She just couldn't be specific.
The violation occurred the moment she introduced specific operational details.
She gave away the secret recipe. But, there is a profound irony here.
Definitely.
The psychological pressure cooker of this exam, the hundreds of hours of studying, the career implications, it pushes people to their absolute breaking point. The intense pressure of the ethics exam, ironically, pushes candidates to bend the very ethical rules they are trying to prove they have mastered.
It is a fascinating behavioral paradox. You test them on ethics by putting them under so much pressure they forget their ethics.
We have covered incredible ground today. We started on the manicured greens of a golf course, dissecting how casual whispers about earnings can trigger illegal ETF trades.
Right.
We watch a bank president artificially pump up his own stock with a massive fake-out buy order to trick quantitative screeners.
A classic maneuver.
We explored the subtle corruption of soft dollars, where client trading fees secretly subsidize analyst research. We saw managers desperately cherry-picking their historical performance data to look like infallible geniuses.
Yep.
And finally, we saw the unbending draconian rules protecting the integrity of the credentials themselves.
It is a comprehensive tour of where human frailty collides with massive financial incentive.
It really is. And it brings us back to that Formula One driver's ed manual we talked about at the beginning.
Yeah.
These complex, interlocking rules exist because the velocity of capital is so high and the potential for a catastrophic market crash is so real. But diving into the minutiae of these regulations leaves me wondering about the drivers themselves.
It raises a profound philosophical question, and one I think is essential for anyone navigating the financial world to really consider.
What's that?
The code and standards we explore today are incredibly detailed. It is an exhaustive, microscopic checklist of permitted actions and severe prohibitions.
Right.
But we have to ask, does codifying ethics to this granular degree actually cultivate moral professionals? Or does it merely train highly intelligent people to become experts at finding the loopholes?
No, yeah.
If ethics becomes just another regulatory obstacle course to navigate, do we risk losing our innate moral compass in the pursuit of profit? Are we teaching the industry to do what is fundamentally right, or are we just teaching them exactly where the edge of the cliff is so they can walk right up to it without falling over?
That is something to seriously ponder the next time you read a seemingly perfect, entirely confident financial prospectus. The guardrails are massive, but the race is always on. Thanks for joining us on this deep dive.